Okay, chapter 6 is actually a very simple chapter, nothing much in it, and it says how we compare the numbers where what happens if we are taking debt and what happens if you're not taking debt. So here is given an example of a bookshop where this makes 100 million in trading profits, which this is pounds because this is a UK exam book, and Bob's Bookshop. Very steady business has been built over the decades. It makes 100 million in trading profits each year. It does not like taking financial risks. Right. So the sales are 1000, average is 100, interest cost is 0, PBT is 100, 20% is tax, 80% after profit after tax. Again, equity is 1000, so you get an ROCE of 10%. But what happens when you take debt? When you take, see again, this is 100, you pay 10% as your interest cost, PBT is 52, taxation is 10.4, and you get 41. So basically your equity over here is 200 and your debt over here is 1000. You go by same, total capital employed is 1000 and you are making ROCE of 10% as per the book. But I don't think so, they should be 10%. See, this is misprint over, they should be 4% of it. If I am talking about ROCEs, but if I am talking about ROEs, which this chapter tells you ahead, is then your return on equity will shoot up like anything. ROEs is 8% over here, but the ROE over here is 21% because my why? Because my equity over here is 1000, so I am dividing 80 by 1000 to get my ROEs, which is 8%. But here my equity is 200, and I am dividing 41.6 divided by 200, which gives me a very shooting ROE. It is drastically high. So selling books, he says, is not a good business. If the ROC is 10% is medium, but ROE is 8%, which is not very great because of this. So what debt will do? Debt will actually reduce your equity into the business. In this way, shoot up your ROEs because of this. But debt can go wrong also if you are not able to service the debt. If you are not able to pay the money that we learned in the above chapters, cash flows, free cash flows. If you don't have, then you cannot able to service your debt, which is bad. So there is given some examples. So EBIT and ROC have not changed, which is okay. Obviously, it has changed, but this means the ROC is still at 10%. He says, and the debt why it increases because of adding on to your debt and reducing your equity. So it is a risky thing. It can take you both ways. The risk to the shareholders has increased. Why? Because the debt payments, the debt holders, here it was 0, here it is 2.8, which is less. The bond holders or the debt holders are paid before the equity shareholders are paid. So the risk has gone up and ROEs have gone up. If the cycle is good, if you are going good, then good. But if the cycle is bad and you are not able to service the debt, you have a good amount of problem. So it was a very simple and easy chapter. Again, don't go with these numbers, just understand the logic, just understand the topic which is discussed here, so you can have a good grip of all this.